Good morning and welcome back. Welcome to week 2 of Principles of Accounting 2. This is Managerial Accounting. Last week we covered chapters 15 and 16. Today we will cover chapters 17 and 18. Last week you had a quiz and an assignment. This week you'll have a discussion board and a quiz. All of which must be completed by Sunday night, as it is every week. So every week you'll have 2 assignments. This week is a discussion board and a quiz. So please make sure that both of those items are completed by Sunday night. For the discussion board, I recommend very strongly that you participate early on. For discussion boards, it's best to have your initial post done by Thursday, and your 2 responses to 2 of your classmates done by Sunday. So that way, that's 3 posts total. Each post should be at least a paragraph in length. And if you can, please try to include references where you find them. Okay, and I'll send out an email about that, about what kind of like an ideal post looks like, perfect post, so to speak. Okay, so let's go ahead and get started with Chapter 17, Process Cost Systems. In the last chapter, we talked about other types of cost systems, so this is a little bit more about this is all about cost. Now, just as we talked about in the earlier chapters, I want you to keep the mindset of manufacturing. Manufacturing, as you know, is assembling products, getting them put together and then selling them, right? Manufacturing is taking the raw materials, bringing the raw materials to the assembly line, creating the product, whatever it is. In our example, it's usually a guitar, is the example that we're going to use today. So you take your wood and your string and your metal facets, you take all of those raw materials, you put them into your work in process to put together your guitar by sanding and drilling and cutting and gluing to create your finished good, which is your guitar. And then you get that ready for sale to your customers. So keep that process in mind because throughout this course, we focus a lot on cost. We focus a lot on process. And so that's why this chapter happens early on. If you have questions throughout the presentation, please feel free to stop me and ask your question. You can unmute. The best way to do that is to unmute yourself. Okay, so let's go ahead and get started. So let's talk about process manufacturers. A process manufacturer produces products that are indistinguishable from each other using a continuous production process. Indistinguishable means you cannot tell the difference from one product or another. They're the same product. Examples of this would be oil, paper, chemicals, aluminum, and food. The process of manufacturing these items, it is continuous, and you can't tell the difference from one to another. So 1 gallon of oil to another gallon of oil, you can't tell the difference. There's no difference. That's what indistinguishable means. So process manufacturers, they continually process indistinguishable items. So like paper, oil, chemicals, aluminum, food. These are all items that you cannot tell the difference between the two, and it's a continuous process. When you think of continuous, think of like a conveyor belt that runs 24/7. The processing continues continuously, right? The cost accounting system used by these types of manufacturers is called a process cost system. The process cost system records product costs for each manufacturing department or process. So in the example of oil, the first department is the extraction department. They extract the oil from the ground. The second department is transportation. The third department is refinery. The fourth department is transportation again. Fifth department is sales. All of these involve a process. Extracting it from the ground is a process. Refining it is a process. Each process has its own system to record costs. We call that process cost system. Now, just like we learned earlier, we talked about job orders. We talked about that in the last chapter. In this chapter, we're talking about job orders from a process cost system perspective. A job order manufacturer produces custom products for customers in batches of similar products. Example would be wedding invitations, furniture manufacturers, shipbuilders, home builders, and guitar manufacturers. The cost accounting system used by process manufacturers are called the job order cost system, which we learned about in the previous chapter. The job order cost system records product cost for each job using cost sheets. Now let's take a look at the comparison of a couple of different companies that produce different products. Process manufacturing companies would include companies like Pepsi, Alcoa, Intel, Apple, Hershey. Their respective products are soft drinks, aluminum, computer chips, the iPhones, and chocolate bars. The reason why these companies and these products are classified as a process manufacturing is because it's continuous. There's no pauses. They don't do batches. When it comes to soft drinks, there's a several miles long conveyor belt that continually fills the bottles with the soda. The same with processing aluminum. There's machines on a conveyor belt that continually processes the aluminum. Same with computer chips, iPhones, and chocolate bars. It's continuous. So when you hear the word continuous, think process manufacturing. It continually runs. It doesn't matter. There's no stopping, right? It's on a conveyor belt. When you think of job order companies, think of batches. They make things in batches. Examples of this would be Disney. They make movies. They make batches of movies or individual jobs for movies. Nike, they make shoes in batches. Nicholas Design, apparently they do golf courses, that they design golf courses. Those are done by the job. Log homes, those are custom built homes, so that's done by the job. Advertising, that's done by the job. So they're kind of like one-offs, right? So if it's a one-off or if it's a specialized type of thing, it's a job order company. Process and job order systems are very similar. The way that they're similar is they both record and summarize product costs. They both classify product costs as direct materials, direct labor, and factory overhead. They allocate factory overhead to the cost of the products. They both use perpetual inventory systems for materials, work in process, and finished goods. And they both provide useful product cost information for decision making. Now remember, since we're a manufacturing business and we're going to be talking about manufacturing throughout this entire course, keep in mind that every time we manufacture a product, that product has direct materials, direct labor, and factory overhead. Those three things will never change. The cost of direct materials, direct labor, and factory overhead are applied to each product, regardless of whether it uses a job order or process cost system. So how do the two look graphically? The top is a process cost system. In this example, we use ice cream. Ice cream is a process cost system because we continually make ice cream without stopping. We don't do it in batches. We don't do it in jobs. We do it continually. So therefore, it is a process cost system. Here's how it works. We take our direct materials, our raw materials. For ice cream, that would be dairy, milk, cream, and sugar. We take the direct materials, it goes to our mixing department. Our mixing department mixes those direct materials together using labor. So the labor for that mixing department is also identified as direct labor. Then from the mixing department, it goes to the packing department. The packing department packs the ice cream that was made by the mixing department, puts it into containers. And then they put those containers into boxes. And then they ship those boxes to their customers. But you can see the process. Direct materials goes to the mixing department, goes from the mixing department to the packing department. From the packing department, it gets sold. But you see the process flow. Direct materials, direct labor, factory overhead, goes from mixing, gets transferred to the packing department, where more direct materials, more labor, more factory overhead gets applied to eventually make its way to a finished good. Now that's a little bit different from the job order cost system that we learned about last chapter. In the last chapter, we discussed job order cost system, which includes the same direct materials, direct labor, and factory overhead. The difference here is that for work in process, it's done by the individual jobs. It's not continuous. We don't continually make guitars and continually sell guitars. We make guitars when we receive a job order from our customer. And so we take our direct materials, direct labor, factory overhead, apply that to our job sheet. It goes from the job sheet to the finished good. So that's the primary difference between process cost system and job order cost system. Process cost system is continuous, and it usually involves transferring from one department to another within the work in process. Whereas a job order cost system, there is no transferring. Everything gets done by the job. We'll talk more about that. Process and job order cost systems are different in several ways. One is that a process cost system accumulates and records product costs, work in process accounts for each department. So looking back at our diagram, each department accumulates its own list of costs. Direct materials, direct labor, factory overhead for the mixing department, and then that goes from mixing department to the packing department, where more direct materials, direct labor, and factory overhead get applied. So that's one key difference. With job order cost systems, it's accumulated by each job. And we see that down below. Each job has its own direct materials, direct labor, factory overhead. It doesn't get transferred to another department within work in process. In a job order cost system, work in process at the end of each period is the sum of the job cost sheets for partially completed jobs. We call that work in process. Work in process. In the process cost system, which is the one that's continuous, the work in process at the end of the period is the sum of costs remaining in each department at the end of the accounting period. So in other words, at the end of the month, after when I total everything up, for my work in process, I look at it by each individual department, not by total jobs. I look for process costing, I'm looking at each individual department, not by the total jobs. So let's break it down a little bit further. In a continuous process flow, we take our direct materials, it goes to our first department, then it goes to our second department, and then it becomes finished goods. But we can see the process. this is the ice cream manufacturing. We take our dairy, milk, cream, and sugar. Those are our raw materials. We bring it to our mixing department. We mix it all up. In the mixing department, we're adding in direct labor, the cost of the person mixing the materials together. And then we take it out of the mixing bowl and we put it into packages. There's more direct labor involved and even a little bit of materials expense, because you have boxes. You have the person putting the materials in the boxes. And then we move it from packaging department and we put it into finished goods. Now, as you know, when we store something in finished goods in a freezer, there's going to be cost there as well. It's the cost of storing the material and the cost of getting it from the packing department to the freezer. But as you can see, it goes from raw materials to the first department, from the first department to the second department, and from the second department to finished goods, and then eventually it gets sold. At each stage, there's cost. Materials is raw materials cost. Mixing department, there's labor plus the raw materials cost. In the packaging department, there's materials cost plus the labor plus the packaging. And then from there it goes materials cost, labor, packaging, storage. But you see that as it moves, additional cost gets added. We'll talk more about that. Here's how it looks from a cost flow perspective. At the very beginning, you have your materials, your raw materials. We purchase the raw materials by debiting our raw materials account and by crediting direct materials. We then transfer our direct materials over to our work in process when we take it out of our materials inventory and put it into work in process. So we in that part, we debit direct materials and we credit costs of transferred out. Now here's the thing. There are indirect materials with our materials. This would include things like, if we were talking about ice cream, this would include things like the packaging for the ice cream. It would include things like the lids for the packaging, the boxes, right? So that gets transferred to factory overhead because it's indirect. It doesn't make up the most of the cost. The ice cream makes most of the cost. So ice cream goes to the work in process into the mixing department. We have our direct materials plus direct labor plus factory overhead. The factory overhead allocation from the indirect materials, things like that, right? And then we transfer all of that out. And it goes to the next department, which is the packaging department. There we have the same direct materials. We have the cost transferred in, direct labor, more factory overhead. But the point that I'm getting to here is that you see with each department, there's additional cost added because you have additional labor, additional materials, additional factory overhead. So every time you move something from one department to another, there's a cost. And when it makes it out of the packaging department into finished goods, there's cost for transferring it there. And then from there, our finished goods becomes cost of goods sold when we sell it. So it's a nice graphical representation.
So I have a question before you continue.
Yes, Maya.
For this slide, for like accounting purposes,
Yep.
would there be separate invoices showing all of this? Or
Yes.
would it just be, okay.
Yep. So you'll see, and those what you just called invoices. That's going to be this. This is going to be your sheets. It'll be a process cost sheet, and those process cost sheet will go with the product as it moves through each department. So the short answer to your question is yes. There will be invoices or process cost sheets. Absolutely. And we'll talk a little bit more about that. Okay. Let's talk about the reporting from the process cost system. In our process cost system, the cost of units transferred out at each processing department must be determined along with the cost of any partially completed units remaining in that department. In other words, looking at our company making ice cream, it's continuous, right? So what this means is that there's going to be materials in both the mixing department and the packing department and in finished goods at any given time. They're always working. So therefore, they're always going to have direct materials, direct labor, factory overhead in each department at all times. So at the end of the accounting period, we have to account for what is in each department at that given time. So how do we do that? We look at the partially completed units within each department. A partially completed unit is like, oh, we filled half of the tub of ice cream in the packaging department. Oh, we were mixing one batch, but we haven't mixed that second batch yet, right? Those partially completed units. It's in process. So we generate this report called the Cost of Production Report, which summarizes production and cost data for each department by looking at the units the department is accountable for and the disposition of those units. And we also look at the product cost incurred by the department and the allocation of those costs between completed and partially completed units. We'll break it down a little bit further into steps. The cost of production report is prepared by the following steps. Step 1, we figure out the units to be assigned costs. To figure that out, we take completed and partially completed units. Those are the types of units we assign cost to. Step 2, we compute the equivalent units of production. There's a formula there, but don't worry, we'll talk about it here in the next few slides. Step 3, we determine the cost per equivalent unit. There's a formula there as well. Don't worry, we'll talk about it. And step 4, we allocate costs to units transferred out in partially completed units. That part gets a little bit complicated, but don't worry, I'll show you how it works. Okay, so in preparing a cost of production report, it requires making a cost flow assumption. We discussed this in earlier chapters. So just like any type of other inventory, we have to decide whether we're going to use first in, first out, last in, first out, or weighted average. I'm certain you all remember these concepts because I want to say we discussed this back in Accounting 201. What chapter was that? I think it was 14 maybe? Or was it even 15? I don't remember. But I know it's toward the end of 201 and at the beginning of 202. But I know that we talked about these concepts. So those concepts come back, right? Because anytime we're talking about inventory, we're talking about cost of inventory. First in, first out, last in, first out, weighted average. So because first in, first out method is often the same as the physical flow, first in, first out is typically used in this chapter. Because I want you to think about the way that things physically flow. With process costing, because it's a continuous process, first in, first out makes the most sense, especially when we're talking about something like food or ice cream. We know that that expires, right? So because the product expires, first in, first out is the most logical cost method to use in this process. Okay, let's look at it from an example. Cost production report for the mixing department for our ice cream company for the month of July is prepared. Here's the July data. At the beginning of July, we had 5,000, oh, I'm sorry, I don't know what happened there. A sensitive mouse. At the beginning of July, we had 5,000 gallons of raw materials. Or 5,000 gallons in raw materials. Okay, so we had 5,000 gallons of raw materials. Again, your raw materials are your milk, your cream, your sugar, okay? Your butter, whatever. So 5,000 gallons, $1 per gallon is $5,000. We have conversion costs. Conversion costs for the 5,000 gallons, we're currently 70% complete. What does this mean? This is inventory and process. So when we talk about inventory and process, we're talking about where in the process is it, okay? So looking at our ice cream, in the mixing department, we've completed 70% of the 5,000 gallons. So to figure that out, you take your direct materials, 5,000 gallons, in this case it's $1 per gallon, so $5,000, times 70%. So 5,000 times 0.7 equals $1,225. So at the beginning of the month, our total inventory in process is $6,225. Then in the month of July, obviously we must have purchased more, or we must have processed more, right? It looks like we went through 60,000 gallons of ice cream and indirect materials. So 60,000 gallons of ice cream at whatever cost that would have been, so 66,000. Direct labor for cost for July. This is our hourly wages that we paid out for the month of July, $10,500. Our factory overhead for the month of July, we said, was $7,275. To give us a total production cost of $90,000. Why the $90,000? Beginning inventory plus the inventory throughout the month, plus direct labor, plus factory overhead. Gives us the $90,000 for the month of July. Now, here's the question. We have gallons transferred to the packaging in July, which includes what we had at the beginning of the month, 62,000 gallons. Question mark. So how many gallons did we transfer? I don't know yet. Inventory and process at the end of the month was 3,000 gallons. We were 25% complete to conversion cost. So how much is that? By preparing the cost of production report, the cost of the gallons transferred to the packaging department in July at the end of the working process period, inventory mixing department are determined. So in other words, looking at our example here, we can figure out how many gallons were transferred to the packaging department within the month and what we have in process. So if it says here that I transferred 62,000 gallons, and this includes what we originally had in the beginning of the month. So 60, let's see here. So we got, throughout the month, we had 66,000, let's see. We had 66,000 gallons, right? It said it included that original 5,000. So 66 minus 62, that'll tell us how many units we transferred. And then for the inventory and process, you take your 3,000 gallons that we had at the end of the month times 0.25, 25%, and that'll give you your inventory and process conversion cost. So let's determine the units to be assigned costs. This is our partially completed units. The first step is to determine the units to be assigned costs. A unit can be a measure of completed production, such as tons, gallons, pounds, barrels, or cases. In our ice cream example, we use gallons of ice cream. The mixing department is accountable for 65,000 gallons of direct materials during the month of July. How do we get there? Remember, we started the month of July with 5,000 gallons. We transferred 60,000 gallons of ice cream from raw materials to work in process. That gives us to the 65,000 gallons. Remember, beginning balance plus transfers in equals total gallons for that department. For the month of July, there are three groups of units. Three groups of gallons are assigned costs. Group 1, gallons in the beginning work in process inventory on July 1. That's 5,000 gallons. Group 2, gallons started and completing during the month of July. That's 60,000 gallons. Group 3 is ending work in process inventory, which is 3,000 gallons. Okay, we started the month with 5,000 gallons. Okay, so instead of the 60, it was 57,000 gallons were started and completed in the month of July. And we ended the month with 3,000 gallons in that department. So what does this tell us? For the month of July, we had 60,000 gallons. 57 that were started and completed in July, and we ended the month with 3,000 in that department. But we started the month with 5,000. So that means 65,000 gallons total need to be assigned costs. So group 1, let's see how that's done. In group 1, we started the month with 5,000 gallons. In group 2, we started and completed the month of July of 57,000 gallons, which means we transferred out to the packaging department 62,000 gallons. We had an ending inventory within the mixing department of 3,000 gallons, which tells us that we need to assign costs total gallons of 65,000. Okay, so there's two types of units you need to be concerned with. One is called a whole unit. The other one is called equivalent units of production. A whole unit is a full gallon, well, mostly a full gallon. These are the number of units of production during the period, whether it's completed or not. Mostly a full gallon. Some of it might be a partial gallon. Equivalent units of production are the portion of whole units that are complete with respect to either materials or conversion, which would be direct labor and factory overhead costs. So think of it this way. A whole unit, it could be a full gallon, it could be a partial gallon. Equivalent unit is a full gallon that includes the conversion cost. And we'll talk more about that. So here's an example of how to compute equivalent units of production. So let's say we have a 1,000-gallon batch of ice cream that's only 40% complete in the mixing department. So the batch is only 40% complete as to the conversion costs, such as power. Power meaning electric. In this case, the whole unit and equivalent units of production are as follows. So whole units is 1,000 gallons. My equivalent units is 1,000 gallons. That's for materials cost. Conversion cost. Whole units is 1,000 gallons. Because remember, whole units means it can be partially complete, totally complete, doesn't matter. Equivalent units means complete units. It said that we completed 40%. So, which means we have conversion costs of 400 gallons. How do we get 400 gallons? We took our equivalent units, which is 1,000 gallons, times 40%. Why 40%? Because we're 40% complete. So 1,000 times 0.4 is 400. Everyone's good so far, right? Any questions?
No, I'm good.
Great. Thank you, Samaya. Thank you, Narciso. I saw you were getting ready to say the same thing. Okay. Equivalent units for materials and conversion costs are normally determined separately. This is because materials and conversion costs normally entered in production at different times and rates. So think of it this way. The reason why we would compute materials and conversion costs separately is because we might be at different points throughout the process. Raw materials goes to the mixing department. Mixing department goes to the packaging department. Packaging department goes to finished goods. In that process, there are going to be different conversion costs for each process. There also will probably be different times and different rates for each process. So that's why we compute them separately. And we'll talk a little bit more about that as the chapter goes on. In contrast, direct labor and factory overhead normally enter the production at the same time at the same rate. So the cost of labor usually isn't different for each department. Sometimes it is, but normally it's the same. And the overhead is usually always the same as well. The overhead for the mixing department and the overhead for the packaging department usually aren't that different. The rate is usually the same. So for this reason, direct labor and factory overhead are combined as a conversion cost in computing equivalent units. So to compute equivalent units for materials, it's necessary to know how the materials are added during the manufacturing process. In the case of our ice cream example, all materials are added at the beginning of the mixing process. In other words, when I start up my mixing bowl, I'm putting in my milk, I'm putting in my sugar, I'm putting in my cream. And because of this, the equivalent units for materials in July are the following. Remember, group 1, we started the month with 5,000 whole units. We didn't add those units in the beginning of July. So for group 1 and 0. Now, we started and completed 57,000 units in the month of July. So that would be 100%, 50,000 units, our equivalent units. We transferred out to the packaging department in the month of July 62,000 units. We started with 5,000. Then we had 57, so we're up to 62. 62,000 units. We transferred out 57. Group 3, inventory in process. We had 3,000 units left at the end of the month in our mixing department. So that's 3,000 at 100% materials for the month of July. So total gallons to assigned cost, we said we're 65,000 because we transferred out 62 plus the 3 we had at the end of the month at 65. But the equivalent units for direct materials is only 60. Why it's only 60? Because at the end of the month we had 3. We didn't transfer the 3 out to the packaging department. The 3 were left over. So it's 57. Okay. So again, group 1, we started with 5,000 units. Group 2, 57,000 units. Group 3, 3,000 units. 3,000 units at the end of the month. 57 plus 3 is 60. We need to assign cost to 60,000 units total. Step 2. To compute equivalent units for conversion costs, we need to know how direct labor and factory overhead enter the manufacturing process. Direct labor, utilities, equipment depreciation are often incurred uniformly during this process. For this reason, we assume that our ice cream company incurs the conversion costs evenly throughout the manufacturing process. In other words, it's not going to be different from the mixing department to the packaging department. The cost of the overhead is going to be the same. Okay, so here's how it's broken out. Beginning of the month, we completed 70% of our 5,000 units. We converted during that original group 30%, which is 1,500 units. Group 2, we had 57,000 units. We converted all of those because they were done in the month of July. Obviously, you add your beginning inventory plus your July's inventory. Group 3, we processed 25% of our inventory. So 25% gave us 3,000 whole units. Of that, 25% is 750 units equivalents for conversion. And therefore, we ended with 65,000 whole units and 59,250 equivalent units. Okay, so again, looking at the time frame for the month of July, of the original beginning inventory of 5,000 units, we converted 1,500 units. All 57,000 units and 750 units. You get 59,250 total equivalent units for the month of July. Here are the important formulas you need to know. Okay? Once you know these formulas, it gets really easy. Okay, cost per equivalent unit for direct materials and conversion costs. For direct materials, per equivalent unit, we take the total direct materials cost for the period divided by the total equivalent units of direct materials. The second formula you need to know is the conversion cost per equivalent unit. Here we take the total conversion cost for the period divided by the total equivalent units of conversion costs. So let's break it down through an example, through our example we've been using. Okay, so looking back at the formula, direct materials cost per equivalent. Total direct materials cost for the period divided by equivalent units of direct materials. So looking at our example, total direct materials cost for the period, 60,000. Total equivalent units of direct materials, 59.2. Oh, okay. Oh, I'm sorry. Cost. I'm looking up top. I need to be looking at the cost. I'm looking at the looking at the gallons. Sorry about that. Direct materials cost for the period, 66,000. That's funny. Total equivalent units of direct materials, we said were 60,000 gallons. Total equivalent, total equivalent units for direct materials, 60,000. Total cost, 66. So you take your 66,000 divided by 60,000 gallons, gives you $1.10 per gallon. That's your direct materials cost per equivalent unit. Then you take, for the second equation, the conversion cost per equivalent unit. You take your conversion cost for the period, divided by the total equivalent units of conversion cost. So what does that mean? Conversion cost per unit, we said it was 17,775. How we got to 17,775? That is, of course, our direct labor plus our factory overhead. That's how you get conversion cost, is direct labor and factory overhead. So direct labor, factory overhead, 17,775 divided by 59,250, which is our conversion for equivalent units, gets us to 30 cents per gallon. Now, step 4. The product cost must be allocated to the units transferred out and partially completed units on hand at the end of the period. The product costs are allocated using the cost per equivalent unit for the materials and the conversion cost we computed in step 3. So in this case, it would be $1.40. How we got per gallon. How we got there was we took our direct materials cost per equivalent unit plus our conversion cost per unit. As we can see, is $1.40. Okay. The total production cost to be assigned is $90,000, and here's how it was computed. You took your $5,000 for your initial materials cost, which was also 5,000 gallons. So $1 per gallon. Conversion cost 5,000. We completed 70%. That's 1,225. Now remember, conversion costs are your direct materials and factory overhead. So direct materials plus direct materials plus direct labor, factory overhead equals total inventory in process, 6,225. For the month of July, we completed 60,000 gallons at a cost of $66,000 for the direct materials. Labor was $10,500 for the month. Factory overhead was $7,275. For a total cost incurred of the month, $83,775. We take our inventory at the beginning of the month plus our total costs incurred for the month to get to our total production costs of $90,000. For that beginning inventory of 5,000 gallons, they were completed and transferred out to the packaging department in the month of July. Here are the costs here's the cost breakdown. Inventory in process, 6,225. The equivalent units for completing the process is 1,500. $1.10 times 0 is 0. 30 cents times 1,500 is 450. Our cost for the completed July 1st inventory in process is 450. 6,225 beginning inventory plus 450 for the completed conversion cost gets us to $6,625, which was transferred to our packaging department at the beginning of the month. This example is okay. It's really not the best, in my opinion, but it's what our book gives us. For the 57,000 units that we started completed for the month, all 100% of them were direct materials and conversion costs for the month of July. So the 57,000 gallons started and completed are computed by multiplying the 57,000 gallons times the cost per equivalent unit and the conversion cost. 57,000 times $1.10, 57,000 times 30 cents. And you add those two together to get your total conversion cost for the month of July. The total cost transfer to the packaging department in the month of July is the sum of beginning inventory plus the cost started and completed for the month. So 6,675 plus 79,800 gives us 86,475. There were 3,000 gallons in process at the end of the month. These were incurred. They incurred all the direct materials costs and 25% of the conversion costs in the month of July. The costs of these partially completed units are as follows. You have your 3,000 gallons times $1.10, which is your conversion cost per gallon, equals 3,300. Then you also have your conversion cost. 750 gallons at the end of the month were transferred. 30 cents per gallon was the conversion cost. Gets you to 225. So 3,300 plus your 225 is 3,525. Almost there. To summarize the total manufacturing costs, we have Group 1, Group 2, Group 3. Beginning of the month, 5,000 gallons, 675. Group 2, 57,000 gallons, 79,800. Of course, you want to add your beginning plus what you did in the month. And then you get to your end of the month. End of the month, 3,000 gallons left over. Gives us the 65,000 for the total month. And $90,000 for the total cost. So what about the report? Let's talk about the cost production report. It's prepared for each processing department at periodic intervals. The report summarizes the units of which the department is accountable for and the disposition of those units, and the production costs incurred by the department and allocation costs between completed and partially completed units. Here's how the report looks. This is using first in, first out. Remember, first in, first out is used by companies that use continuous process. You can see in column B we have our whole units. Column C and D we have our equivalent units. And it goes through the same concept. This is just kind of like how it's formatted, right? Then, of course, you have your costs. And if you go through this whole process, you arrive at the same amount. This is kind of an example of what it looks like. Now, as you know, there's journal entries. There's journal entries for pretty much everything we do in accounting. So there's journal entries for the process cost system. The journal entries for our ice cream transactions are on the next few slides. To make it easy, the entries are shown in summary form, although some of them would be recorded daily. Okay, first transaction. We purchased materials. Those are our raw materials, right? milk, cream, sugar, packaging, indirect materials, things like that. We purchased materials for $88,000. So we debit our materials inventory, $88,000. We credit accounts payable, $88,000. We haven't paid it yet, so accounts payable. It does say on account. B, our mixing department requisitioned. When you see the word requisitioned, it means transferred. Requisitioned, transferred. In other words, the mixing department sent a requisition form, which is a request to transfer inventory from raw materials to the mixing department. Requisitioned. That's what the word requisition. Fill out a requisition form. You're requesting that the raw materials sends the requested materials to the mixing department. Requisition. Mixing department requisition milk, cream, sugar for $66,000 worth. This is the total amount from the original July data. Packaging materials of $8,000 were requisitioned by the packaging department. Indirect materials for the mixing and packaging department were $4,125 and $3,000 respectively. That could be things like wrapping paper, labels, other small random things, right? Okay, so we debit work in process for the mixing department, $66,000. We debit work in process packaging department, $8,000. We debit factory overhead for the mixing department, $4,125. And we debit factory overhead for the packaging department, $3,000. And we credit our materials, $81,125. Questions so far? Are we okay?
I think we're doing okay, Professor.
Good. Is all this making sense? I mean, it's kind the examples, in my opinion, not the best example, but is it making sense?
Yeah, it is making sense to me.
Okay. All right, good. Thank you. Okay. The third journal entry we make is we incurred direct labor in the mixing and packaging departments, $10,500 and $12,000 respectively. So we debit work in process mixing, debit work in process packaging, and credit wages payable, $22,500. Transaction D, we recognized equipment depreciation. As you know, depreciation is something that happens on a regular basis as well, and it must be accounted for. We have depreciation in the mixing and packaging departments. It's usually from like machinery, right? We depreciate factory overhead mixing, $3,350. Depreciate packaging department, $1,000. So debit, and then we credit accumulated depreciation for our equipment, $4,350. Remember, debits must always equal credits. Debits must always equal credits. Doesn't matter how many line items you have or how many accounts that you're affecting, your debits must always equal your credits. Transaction E, we applied factory overhead to mixing and packaging departments, $72.75 and $3,500 respectively. So debit your work in process accounts for each department and credit your factory overhead accounts for each department. Transaction F, we transferred costs of $86,475 from the mixing department to the packaging department per the cost of production report. So this happens when we're taking out of work in process and we're sending it over to the next department, right? Which is still technically work in process. It's packaging. So we debit work in process our packaging department to put it into packaging department. and we credit work in process mixing department to take it out of our mixing department. Okay, so and then of course we're going to take it out of packaging and put it into finished goods, get it ready for sale, right? So to do that, we debit our finished goods to increase our finished goods by $106,000, and we credit our work in process packaging $106,000 to take it out of packaging and put it into finished goods. And then of course we're going to sell some. So we record this cost of goods sold out of the finished goods inventory, $107,000. So we're going to debit cost of goods sold and credit finished goods. And that's the flow. That's how the flow works. Everything starts from raw materials, and then it gets processed. We take it out of raw materials, we put it into our work in process. Now, work in process, remember, it consists of a few different departments. In this example, you have two departments. You have your mixing department and your packaging department. Both of those departments are a part of work in process. And then from there, it goes to finished goods. Transfers out of materials into our work in process departments, one department to the next department, and then out from that last department into finished goods. So think of it from a logical flow of the product, right? It goes from department to department, ultimately to finished goods, and then eventually gets sold. Understanding that flow, it helps. It helps a lot. Ending inventory. How do we calculate the ending inventory? We have our materials, work in process for each department, our finished goods, gives us our total inventory. In this example, the $3,525 balance work in process for the mixing department is the amount determined from the bottom of the cost of production report that we saw earlier. Okay, so our company from the production report for mixing department shows that we had a beginning inventory of $6,225. July 1st inventory was $6,225, consists of the following. We had $5,000 worth of direct materials, $1,225 in conversion costs, because it was 70% completed at the time. That gave us to $6,225. Okay, so again, remember that there's one of the key things I want you to take away from this chapter are these two formulas. Direct materials cost per equivalent unit and conversion cost per equivalent unit. Those two formulas are they're pretty good to know, very important to know. Just kind of how they work. Okay, let's see. In July, the cost per equivalent unit increased by 10 cents, while the cost per equivalent unit conversion cost decreased by 5 cents. View as following. So, as you might think, or as you know, costs change from time to time, especially in manufacturing. The cost of labor might go up or down. The cost of materials might go up or down. And so when there is a change, we need to identify this change and use the updated data. So from July to June, June to July, we saw an increase in direct materials cost and a decrease in conversion costs. So it's important to recognize those changes as the months go on. Let's talk about a couple of other aspects of manufacturing, and then we'll wrap up this chapter. In manufacturing, companies like to utilize what we call lean manufacturing. Lean manufacturing. Lean manufacturing means there's very little waste. That's why it's lean. Think of like lean meat. If it's lean, it means it's there's not as much fat on it. That's what lean meat is. The same concept applies in manufacturing. Low waste. Lean manufacturing is where we produce high-quality products at a lower cost, at a faster rate, and it's available immediately. That's lean, right? It means to be very efficient. That's another way of thinking about the word lean. It means efficiency. Lean manufacturing attains efficiencies and flexibility by recognizing the traditional production process. In traditional manufacturing, there's usually a little bit of waste. There's unfinished goods. There's kind of stuff all over the place. Traditional manufacturing process workers are assigned specific jobs, which are performed repeatedly, and unfinished products are received from the preceding department. Product moves from process to process, and each function and step is completed. In other words, think of like a car. When you manufacture a car, it goes on an assembly line. On the assembly line, you got somebody that screws in light bulbs. You got another person that screws in the headlights. You got another person that screws in the tail lights. You got somebody who installs the dashboard lights. That's traditional. You have 3 different people that do very similar jobs. In lean manufacturing, it's the opposite. It's usually one person does all those jobs because they're similar in process. We'll talk more about that stuff, but here's an example of a furniture manufacturer. Let's say we're making a chair. The chair goes through the following process. It starts in the cutting department. Somebody cuts the wood. Then it gets moved to the drilling department. Somebody drills holes in to put the legs in and stuff like that. Then it goes to the sanding department. People sand the legs and the frame and stuff like that. Then it goes to staining. Somebody stains the wood. Then it goes from the staining department to the varnish department. Somebody puts a nice coat of varnish on it. Then it goes from the varnish department to upholstery. Somebody puts the padding and the upholstery and staples it on. And then the final department is the assembly department, where all the parts come together. They put the legs on, they put the arms on, they put whatever else on, and then it becomes a finished product. All of these departments, cutting, drilling, sanding, staining, varnishing, upholstery, assembly, they're all a part of work in process, but they represent individual departments within work in process. The product moves from raw materials and goes through these 7 different departments before it makes it to a finished chair, available ready for sale. That's very traditional. Starts as raw materials and goes through each department within work in process, and eventually makes its way to being a finished good. In lean manufacturing, we combine similar functions together. We combine process into process functions. We call these manufacturing cells. It's where the work centers complete several different functions. Like looking back at this, I can probably combine these first 2 or first 3 together. I can combine these next 2. I can combine these last 2. So here's how that looks. In lean manufacturing, I would combine cutting, drilling, and sanding. I would also combine varnishing and staining, and I will combine upholstery and assembly. It shortens the process. It's the same process, it's just shortened up. Instead of 7 different departments, I have 3 work centers. Those 3 work centers, they perform similar jobs. By combining these, I make the process lean, more efficient. I probably have less people. I have less conversion costs because I'm not converting it from department to department to department. I'm converting it from 7 departments down to 3 work centers. So I'm really only converting it 1, 2, 3, 4 times instead of 9. So it makes a huge difference. That's what lean manufacturing does. Makes things more efficient. So another example is repair and maintenance of manufacturing equipment are service activities. In lean manufacturing, service activities are assigned to individual work centers rather than a centralized service department. This makes things more focused. In lean manufacturing, product is often placed in a movable carrier and is centrally located in a work center. After an example of this, instead of having 7 different departments for making a chair, I have 3 work centers. And I typically have that chair pretty darn close to that respective work center. So that way I only have to move it maybe 2 times instead of 7 different times. So the physical aspect of it also helps it to be more lean. Less you move the chair, the more efficient your work process is. Each work center is connected to the other work center through information contained within a system. In this case, it's a card system. That's one way of doing it. There's a couple of other methods. But the cost of production report is also prepared the same way. So we see that instead of having multiple departments, it's illustrated into just a few. I'm going to skip through that. Okay, let's talk about yield real quick. Yield is how efficient I am. That's what yield is, how efficient I am. In addition to unit cost, managers of process manufacturers are concerned about yield. This is how efficient you are. To calculate yield, I take the quantity of material output divided by the quantity of material input. Quantity material output divided by quantity material input. That tells me what my yield is. Higher the yield, the better. Okay, that's the end of chapter 17. Are there any comments, questions, concerns on 17 before we go on to 18? Don't worry, 18 is not very long. It'll take us maybe about 20, 25 minutes. Are we good? I can move on?
Yes, you can move on.
Awesome, thank you.